Hello everyone, welcome to another session of Moneyfy Expert Talk, where we talk to various industry experts about various aspects of personal finance. And I'm Gaurav, your host for today's session. Today we have a very interesting topic, common investment mistakes and how to learn from them, and what are the basic rules or guidelines that every investor should keep in mind while planning investments. And this is a very relevant topic today with the kind of volatility that we have seen in the last few months. And to discuss on the same, we have with us Usha Nair. She is the distribution sales head at DSP Mutual Fund, and she has over 15 years of experience in the asset management industry in various roles in sales and training. So welcome Usha on the call. And before we start, I would request all our viewers to post their queries in the chat window, and we will try to take up these towards the end of the session. So Usha, welcome once again, and over to you.
Thank you, Gaurav, and thanks for giving us this opportunity. It's indeed a pleasure to engage with clients. I'm sure there are a lot of queries. Markets have been, raging high, and it's always in those kind of times, like we say, when you get a beautiful highway with no brakes to apply, is when you need to also drive carefully, and that's when the safety features of the vehicle come into play. So markets are giving us that kind of a liquidity and a free highway kind of a feeling. But of course, it's important to just pull back and think of the rules of the game so that we don't make mistakes in our journey and we reach our destination safe and sound. So should I share the screen, Gaurav?
Yes, please.
Yeah. Okay. I'm just switching off the video so that we don't have a bandwidth issue, and then we'll come back once the presentation is done.
Sure.
Thank you. So why we call this concept a lighthouse, we all know as, people who understand a little bit about navigation. Lighthouse was something that used to guide the captains of various, navigation methods that we used to use, primarily ship, in days when the technology was not developed. And we know, like among all modes of navigation, going through the ocean or sea is probably the toughest because it's so vast with no idea about what is in store for you, right? So in such a, and this was way back when technology or the modern methods of communication was not developed. And a lighthouse always used to mean in guiding the ship with its passengers or the cargo, gives that direction to the captain to warn him of the dangers, of the problems, of the unexpected, happenings that are hidden in those vast depth of ocean, and still take him. So you can't avoid doing it. You really can't not be in the sea or the ocean. You have to navigate. You have to cross the ocean or the water. But at the same time, it is fraught with risk. So how did they travel with the help of this lighthouse guiding them the right path and, avoiding? And we believe by giving this next maybe 30 to 35 minutes, few rules, we would like us both, between we and the team of Gaurav from Tata, to be that lighthouse to our investors, that they enjoy the journey without making any issues. Their boat and their entire, portfolios, their portfolio is treated like a boat or a ship. It is large, it is precious, it has got very important earnings that I, work very hard and make. And that should reach the destination, which is my financial goal, very safe and sound. And we are the lighthouse monitorers or lighthouse supervisors who can guide. Now, are we saying that we are the experts and we know everything, we will never make mistakes? No, we will also make mistakes. So what are we doing in this presentation? We have just put 5 or 6 rules which the traditionally known investment have believed and followed in their life, and we believe that if we follow those rules, then our journey will be safe and sound. And that is the lighthouse. These are the gentlemen who give us the guidance and tell us how to invest, how have we invested, and why have we been successful. So it is like saying, what are the mistakes you make to avoid the mistake, you should know what are the rules that you should follow. If you follow the rule, then obviously mistake does not happen. Correct answer, if you know, then you don't give a wrong answer in an interview or in an examination question. So what are those right rules? And it is when you fail in these rules or when you don't follow these rules that you make a mistake in investing. The biggest mistake that we all make, including me, Gaurav, anybody in the financial market or otherwise as an investor, is we start becoming predictors. We predict. We say that, okay, market is 47,000, Nifty is closer to 14,000, 13,500. Liquidity is high. US Biden has won the election. This is good. Vaccine has come out. So we give attribute reasons and we say markets will do well. Or in March 2020, when COVID was at its peak and we didn't know what was going to happen in the next 1 year, we predicted the opposite. We said markets will go down to 7,500, 25,000, 20,000. This stock will correct. We should only buy gold. So every time we behave like a someone who is an astrologer. This is not about astrology. This is about fundamentals, rationality, and emotions being kept in check. So what is this gentleman and who is he? He is Warren Buffett. For the benefit of all, he is the greatest investor the world has ever seen in terms of his experience, wealth, wisdom, all put together. So, I mean, it would probably be not appropriate, but for want of a better example, I would say like the Amitabh Bachchan of Bollywood, because he is far more experienced than even Amitabh Bachchan is, at least 20 years older than 20 or 15 years older than Amitabh Bachchan is. So that much longer is his experience. Definitely much more wealthy by beyond imagination. Or to say he's the, Tendulkar of investing world, that's also not correct because, from an experience perspective, this gentleman brings in 75 years of experience of having invested his own money and other clients' money like you and me in the equity markets and generated fabulous returns for them. 75 years. Around 15 to 18 years, once you start your investment, he's close to 90 years. That's the kind of experience that you're telling. And that person, it will not be possible for any of us to imagine we will do any job for 75 years. It's not possible, right? That is something he has done successfully and still doing it. As we speak, he's still working. So that kind of a wealth of experience he has. And he tells us not about the wealth he has made, not about how rich he is. None of that matters. What matters is the wisdom that he's sharing. He's saying you don't predict in equity markets. If you predict that rain will happen, it doesn't help you. That's fine. But do you have an umbrella? If you have the capability to predict rain, have you carried a raincoat with you? Have you carried an umbrella with you? Or did you avoid going out in the rain and not get wet? Saying that you predict rain will happen and it rained, so you feel happy that your prediction turned out to be correct, but you didn't protect yourself. So the biblical story of Noah's Ark, that is what it was, right? Among all the believers of Jesus, or God, he's the only one who got protected when that whole floods and everything happened because he built an ark, a boat which could save him, his family, all his livestock, everything could be saved. So what is the point? And God had warned him that something bad is going to happen. But to protect him, he didn't sit and cry. He did something, he built something, he believed in God, and he protected him and the mankind, who were believers of God. So that's a biblical story that we have all heard. But extending that, Warren Buffett says, please don't keep predicting where market will go to 60,000. Yes, if market will go to 60,000, I'm not predicting that. If somebody is telling you that, are you putting money in the market then? Are you just giving me that, like a weather forecast? Or are you actually allowing me to do some action about it? So prediction is not useful. Action is useful. What is action? Building ark, building that boat, carrying an umbrella. That is the ark. Because by predicting, I can come today and in the next 40 minutes, make some fantastic predictions. Now you will have to meet me 1 year from today or 3 years from today to know whether my predictions are right or wrong. You do not know whether I've predicted in the past and that turned out to be right or wrong. So the idea is not to listen to predictions, but to ask, how do I navigate my journey of investing for the next couple of years, 10 years, 15 years, 20 years, whatever is my retirement goal, whatever is my financial goal, can you help me meet the same? That should be the question. Never ever get carried away by people who will predict. In our business, which is about financial management, about equity markets, it is good to say, I do not know. I do not know is a very humble answer to give, and there is nothing wrong. I do not know is acceptable. It's not an interview. It's not about you are asking me my name or my nationality. I'm okay to say I do not know the answer to this question that you are asking. It is such people who succeed in this business of investing. What has happened? Why are we putting this? Is a little technical, may not be relevant to most of us, but why are we putting this? It is to give, you just have to concentrate on that 0% which is visible on your screen, where it is actually today the interest rate that is prevailing in most part of the world. We are lucky. We still earn 2.5 to 3% on our savings deposits. We earn about 5% on our FD, our PPF or such investments are also earning us something. What is tough is in many of the Western developed markets, you are earning either nothing or in some markets, in extreme scenarios, you are earning negative interest rate. Now you may ask, what is negative interest rate? If I put 100 rupees in the bank, when I take the money back after 1 year, 2 year, whatever period, I'll get 99 rupees back. So you'll say, how does this possible? Yes, that is called a negative interest rate. And it is real. In reality, it is happening today in the world. So what does this imply for you and me as Indian investors? It means that interest rates have come down significantly, and we cannot believe that the 12% interest rate, 8% interest rate, 10% interest rate that happened in the past is something that I can take for granted. So world is moving to a low interest rate regime, low interest rate scenario. Is it good? It is good in some ways, it is bad in some ways. It is good for if I'm only an investor, if I'm a retired person, I was working in a PSU, I retired, or I was in a private sector job like the way I am today and I retired, I have some retirement corpus. And if interest rates come down, it is difficult for me because my income keeps reducing. I'm not making money now, I'm not employed anymore. I have to live with the income that I generated during my employment years. But that is reducing if the interest rate falls. But on the contrary, I'm only 22 years, 25 years old. I just passed out of a college. I got a job. Maybe I got married. I'm not married, whatever it is. And I want to buy a house. I want to buy a vehicle. Okay. I want to take a personal loan and travel abroad because that's probably today's generation, things like that. When I go to a bank to take a housing loan, interest rates are low. So it's an advantage for me. When I took interest rate 15 year housing loan 15 years back, when many of you did that, interest rates, LIC we went, or any of the banks we went, we were given 20, 12%, 13%, 14. My first home loan was at 14%. So, but today when you go to the same bank and ask, it would be about 8% or 8.5%. Now that's beneficial for me as a borrower. If I'm a businessman, when I want to get some money to do a factory expansion, I'm not an Ambani, I'm not a Tata's, I'm a small businessman. I do need still some loans for expanding my business. I need some rolling over money. For that, when I approach a bank, I get slightly lower interest rate than I got 10 years back, 15 years back. In India, many businesses couldn't survive because of the high interest rate. So it depends on which lens am I looking. Am I looking at the lens of a borrower? So in the same house, I may be unhappy as a retired person because my interest income has reduced, but my son or daughter would be very happy because they are able to borrow at low cost and build house, buy a vehicle or probably expand the business if they are into business, etc. So within the same family, two of us may have two different emotions, but nonetheless, the interest rate as an economy, as world over, is reducing. All the more important for us to look at other forms of investing and improving the return, but keeping risk in mind. The most important variable, alphabet, English alphabet has 26 alphabets. We know when we play different games, you use different alphabets. In different games or sports, there are different meanings for it. But the most important alphabet for equity investor is V. Okay, and today everything is made to look like a V, not V for vaccine, which is fine, but volatility is the biggest, most important thing that you need to remember. Now, nothing better than 2020 to understand. Everything was difficult in 2020, and maybe this will be something that we will all remember till we die. You know, that kind of a year it was. Maybe many of the future generation may not experience this kind of a unanticipated experience. You can't even say COVID or illness or anything. It was overall a very, very different kind of a experience. 1 year back, last December, if somebody told you on 18th of December next year you will be sitting and listening to a call at 4 o'clock where you don't meet the speaker in person, you would have probably laughed. Right. But today, this has become a reality. Every day, Gaurav must be doing an event like this. You would be attending events like this. And also through your work, this kind of a, interaction would be happening. But 6 months, 1 year back, this was unimaginable for us. So that was what this year has taught us. And maybe some of these things are going to be permanent. It is changed for good, something. So thanks to COVID, you can't say that, but maybe it triggered it. Tata Consultancy Services made an announcement that in next 3 to 4 years, we will have nobody working from offices. All our employees will be working from home. Now, did COVID push them to say that, or they were planning for doing that in the past? We do not know. But such experiences, thoughts, outlier ideas are also coming in the world. Coming back to this point, if you see the red line on the left, this was our feeling in the month of March, April, May. And this green line on the right is our feeling in the month of, since say May, June, July or August, and even to. What do I mean by this? What I mean is the correction was equally painful, and the recovery was that much more faster, and I can say happy. But when such a sharp rally happens, you have reasons to be worried, because where is it going to end? Will it become 50,000? Will it become 60,000? Should I be in or should I be out? At least when people were here, there was one certainty. I am worried. I don't want to be pushed into equities. Now, right, wrong, we will come to it in a while from now. But this is actually the nature of market. Is it the first time you're seeing? No, it's not the first time. What is the rule and what is the mistake? When March, April, May happens, we panic. And when today the kind of recovery and the way stock prices are moving up, we start getting so excited, we again forget. That is why I started with the statement that you will see highways and you will see Indian roads in equity investing. You can't be speeding beyond a limit when you get a highway, and you can't say that I will never use a vehicle in Indian roads. I will only walk when I have to drive in Bombay or Chennai or Delhi or whichever part of the country, because every road in India has its own share of problems. Traffic jams are there, gaddas are there, and difficulty in navigating is always there in Indian roads. But we also have in every part of the country beautiful expressways where you can, be it Gujarat, be it Bombay, Pune, be it Delhi, be it the east-west corridor. A lot of things are developing and it is there, and you do get a great driving experience. Now, both happens in the market. Sometimes it happens much more sharply, like it happened in 2020. Sometimes it is very prolonged, like it happened between 2008 to 2014. Okay, now comes the most, we start with the rule. So I set the context why this is important. You need a lighthouse. Your lighthouse is these rules, and we always try to come with the guidance which is following the rules. When I say we, I mean Gaurav and team, as well as every manufacturer, every investment advisor. That's what we do. Now, there is a gentleman called Charlie Munger, who is a close partner of Warren Buffett. He's probably lesser known than Warren Buffett. He's more well known and gets covered more in the media, but nonetheless, you don't have his achievements to be any, smaller. Okay. So this gentleman says that the investing rule number one is, if you buy things at low price, you reduce the risk. Now, let's just reflect back, for a minute. If there's anybody in your family who's listening this with you, if your wife or mother or anyone, they would say, what is she talking? This is something we do every day when we run our household. Yes, that's what a housewife, a mother, a wife, and each one of you, I'm not even being gender biased here. All of us, when we go to buy vegetables, when we go to buy provisions, we go to a big bazaar, we go to a D-Mart, we go to a Wednesday sale, or we go to a wholesale market and buy vegetables and fruits because you get discounts. You go for the, sale that happens in Shoppers Stop or West Side when there is a 30%, 40% sale, the big shopping festival of Amazon. We all understand we are buying good quality stocks. I don't go to a vegetable shop and buy, bargain for 5 rupees or 2 rupees. And when he is giving me stuff, he doesn't give me bad quality stuff. He says 30 rupees a kg. I might say 25 rupees. So that 5 rupees is precious to me. And that's how, but I will still insist he gives me good quality stuff. I will not be happy or satisfied if he gives me rotten vegetables, right? So the good investors say rule number one is to understand that you buy stocks, you invest, whether we do stocks or mutual fund, keep valuation, price in mind, respect price. If you are going to buy at high price, you be prepared for a downside at various points of time. And then he quotes a very easy real life example where he says, and don't buy stocks, or don't, when I say stocks, I don't only mean direct equity investing, I mean mutual funds, PMS, stocks, everything put together. That whole concept of buying equity portfolios, constructing equity portfolio. Don't buy stocks the way you buy vegetables. Don't do the way you buy perfume. So I can extend that logic. You go to a duty-free shop, you get discount, but you can never haggle there. You cannot even ask for a 1 rupee discount. Or you go to any shop to buy perfume. You go to buy, foreign liquor. You really can't negotiate. You have to pay the price they quote. And why are we using these examples? Perfumes or foreign liquor or Apple iPhone, all these things, because these are precious, these are very costly and very, very high quality, high end gadgets. And vegetables is something I consume. My health is dependent on that. And there I am very conscious. I bargain, I buy in seasons. Like right now, we will all be consuming oranges. Come few more months, it will be mango season, and we will make purees of mango, amras, excessive consumption. We will store it for the next year till mango season comes. All of that we do. So this basic intelligence is there with all of us. And Indians, we are absolutely fabulous bargainers. Okay, we are most price conscious people in the world, one of the most price conscious people. We know how to bargain. Whichever part of the country I'm in, if I'm traveling to another part of the country, I know to bargain. If I'm going abroad, I know how to bargain. So bargaining in many ways is there in my blood. I know that. In spite of that, when it comes to stock market, we seem to forget it. So the rule number one, the mistake that we make is we buy at higher valuations. Please be conscious. Don't buy at higher valuations. That is rule number one. What is rule number two? Now, this is more important today than 15 years back. If any of you had invested in equity markets 15 to 20 years back, you would know, you would appreciate what I'm saying much more. You don't be lost in it. Today, there is this call happening. So this is ultimately something about markets. We are talking about that. Now, like this, every day somebody or the other is coming and speaking. On TV, 24/7, you have channels which give you market information, economic information. Newspaper, of course, is there. WhatsApp, Facebook, LinkedIn, all social media and activities provide you 24/7 information. Then you have money control, value research, Morningstar, so many media houses which is giving you information. Then you hear to the Prime Minister, Finance Minister. Then you hear political commentators talking or economists talking what is the impact because of the, Biden winning US elections, farmers strike happening in Punjab, Delhi border. All of these conversations can come. And then you get confused. My brain becomes so, complex. All I need is to invest that 50,000 per month, 2 lakhs per month, 5,000 per month, and plan for my son's education, my daughter's education, my house construction, or my flat buying, or my retirement. This is what my goal as an investor is. But in that, Biden comes, Nirmala Sitharaman madam comes, then farmers agitation comes, COVID comes, every aspect, RBI governor's talk comes, All of this come into play. Does all of this matter? Whatever is the view, whatever is the right or wrong, does it mean that any of my aspiration to send my children to college, higher education, planning a retirement, buying a retirement house, or planning for my retirement, can any of this change? Can I go to Nirmala Sitaraman and say that because you said this, I didn't invest and therefore my planning went for a toss? I can't do that, right? So when that is our goal, why get lost in excess info? We are not economists, we are not fund managers. We have very simple needs in our life to reach a particular destination of financial freedom. For that, why does all of this information matter? So the story is, you have a Google map today. All of us have it on our phone. I come to Bombay. I'm new to Bombay. I get down at the airport or in Dadar or Kurla station, and if I have to go somewhere in Bombay, I type the place and the Google map takes me. On the right hand side, what you're seeing is the Atlas map that we all have seen in the Atlas. We may have studied it in the schools. That's the city map. I don't need to know where is Ghatkopar and Bandra and Mankud and everything. If my destination is Kurla to Ghatkopar or Kurla to Nariman Point, put it in Google Map, sit in the taxi or in the auto rickshaw, he will take you to the destination. They don't care whether there is left, there is right, how big is the city, where is the airport? No. So I have minimal information. Time that it will take me from Kurla to Nariman Point, the other to Nariman Point is shown, shortest route is given, and I take that route and I reach my destination. That is all you need. Don't get confused with, so decide which map you want to use. You want the geographical map of the city, or you want the Google map of the city, which is what you need from an information perspective. Okay, respect base rate. What does it mean? I'll come to the next slide and you will understand. In India, so I started off by showing you that 0% interest rate, right? Now, you can always say that when I started investing, like suppose somebody who's 55, you meet and he says, no, but when I started investing, my PPF interest was 12%. Yes, true, you were getting 12%. That was a rate applicable then. Today, you don't get that. There was bank FDs were giving me 15%. Yes, but if you wanted to buy a house, you had to pay 18 or 20% housing loan, which is why majority of the people of that generation, that is someone who's 70 today, would not have been able to buy a house when he was 30. He wanted to retire, accumulate enough money, and then your life savings went into constructing a house or buying a house. But today, you see 30 and 25 and 32-year-olds willing to buy a house. In 10 years, they clear their housing loan, they buy another property. Now, I'm not encouraging property buying blindly, but I'm just quoting these as examples to establish the concept. Now, life has changed. So you have the base, what has changed? The base interest rate in the economy has changed. Everything, there is a base rate that is prevalent. The cost of masal dosa, the cost of pav bhaji, the cost of a flat, the cost of travel, the cost of school fees, everything has changed. So you don't anchor yourself or correlate to purane zamane ka rate and say that that is what I am entitled to. But when it comes to investing, so we accept all this. You may think, but that is all very common. What is so big about it? We all accept it. Yes. Only when it comes to investing, we say that what was old is gold, and I need to get what was prevailing at that point of time. PPF may, I need 12% in equity, I need 25%. I can desire, but it need not be the case that it will happen. So why is that happening? The growth environment is showing slowing of signs. Interest rates are falling. Company, when I start a business, when I have a 50 crore turnover, when I do 100 crore turnover, that is 100% jump. But for me to make 100%, 100 crore to 200 crore, I have to do in percentage 100%, but the volume of business I have to do is much larger. So therefore, when economies develop, when businesses develop, there will be some signs of slowdown the way we age and slow down as we become 60 and 70 or 55, not like we were when we were 25 to 30 years old. So what you have to understand that valuation change in the market, the dynamics in the market, and respect base rates. Now, what can you do about it? So what does base rate mean? One is it means about the interest rate. Two, it means about the equity market per se. Can you expect Infosys to do the magic of growth that it did in 1990s? Not possible. It is not possible because the company is large, the IT industry has grown. There are much more newer things that are happening, which was not what Infosys was doing many. Does it mean that you should not buy Infosys stock? That is not what I'm saying. I'm giving an example. Today, Maruti car would have been your dream car at some point of time, but today we are talking about electric vehicles. Now, it could happen someday in life, maybe not today, maybe 50 years from today, 25 years from today, I do not know that. But Maruti today enjoys 50 to 55% of the automobile sales in India. It may not be able to enjoy that 10 or 15 years from today unless they come out with newer and newer models which are changing the period of time, right? Maybe they will have 30% market share and 20% will go to some other electric car manufacturer. We don't know that today. So the reason Maruti grew and the reason for Maruti to continue to grow will be very different. So you will have to respect the change economically that is happening. According to that, businesses will change and valuations will change. Today, as we speak, we are in a market which is expensive. In March, I was in a cheaper market. Will your experience be the same if you had invested in March versus if you are investing today? Obviously, the experience will be different. BSE Sensex was close to 25,000 then. Today, we are close to 50,000. So almost 25,000 points rally has happened in a matter of 6 to 9 months. Now, I can regret, I can cry, I can be unhappy about it. That's not the point. The base has changed. What was 25,000 has today become 47,000. I have to grow from 47,000. That time I grew from 25,000. Now let's say I am an investor who had invested then and who's investing today. But I should be very clear that what I enjoyed from 25 to 47 is almost 100%. I will not get from 47. For me to get 100 from 47, it should become 94. थोड़ा दूर की बात है. So let us. So what am I respecting? I am respecting the base. What is my base? 47 is my base today. 25 was my base in March 2020. So please, and that will give you so much more of satisfaction and joy in your investing if you accept that on the first day when you write that check or when you buy that stock. Important to note, by base rate, we mean the price. At what price are you buying the investment? What price? And is that price high? Then please keep that as your base. If the price is low, you have more scope to make more money. That's something that is extremely important. So that was third rule, I would say. Just to revise the rules. Please keep a margin of safety with you always. Don't get bogged down by over information and respect the base rate that is there when you are entering the market, be it interest rate or stock market valuation. When in doubt, that is, if you are not sure what should be done, please don't trust overconfident people. And why is this important? You might think, okay, isn't an expert supposed to be confident? Yes, I am supposed to be confident. Gaurav is supposed to be confident. No doubt in you expecting us to be confident. But we should not be overconfident. Instead of saying all this, if I'm going to give you a view, market will go to 70,000 points. What is the background with which I'm saying that? Do I have the capability to predict? What is my reason for saying like this, right? Unless doctor is someone who says that I treat and he cures. He is God. I treat and he is the one who decides whether to cure you or not. All I can do is I can treat you. I can try to identify and give you the right medicine, but the cure has to come from someone. I mean, now an atheist or someone who's not a believer in God might argue that is not why I'm paying him money. I'm not paying money to God. I'm paying money to the doctor. Yes, point taken. But there is no room to be overconfident in any of these businesses because outcomes can be any way that will happen. What is the story of Amitabh Bachchan and Tendulkar? We, as Indians, we all love cricket and we know Tendulkar is god of cricket. Similarly, we love Bollywood and Amitabh Bachchan is king of Bollywood. But how much ever a great fan I am of cricket and understand Tendulkar's style and I know everything about his batting style, all of that, even if I were an expert on Tendulkar's batting, if someone were to ask me how many runs has Sachin scored in cricket, there would be very few people who will be able to give you a correct answer. That doesn't make me a less interested in cricket or lesser a fan of Sachin Tendulkar. What it just say, what is important if I answer he has scored maximum centuries, he has scored maximum centuries in Test cricket and in one day internationals, and he's the one who was part of the winning World Cup team of 2011. Like that, you have enough and more instances to give to show your appreciation or your understanding of the game. You don't have to go to the extent to say, if I don't give that correct number, that makes me a less proficient person in cricket. Similarly, I may have seen every movie of Amitabh Bachchan 20 times, 30 times. There are people who have seen Diwar or Sholay or Bhagwan, all famous movies of Amitabh Bachchan, and many, plenty of movies. Many, many times. There are more people who have seen 100 times. There are people who will repeat every dialogue without batting an eyelid. But still, if the question comes, how many movies has he acted? Would he know it for sure? I have my own doubts. Does it make you any less a lover of Amitabh Bachchan, a fan of Amitabh Bachchan? No. So why get into something which is not, precision does not matter. Saying how many movies Amitabh Bachchan has acted in very correct number does not get you any brownie points. Seeing his movies, having enjoyed, knowing him, the style in which he acts, the different movies he has acted, and enjoying them is more important. Seeing Sachin play, the style in which, the comfort with which he bats, the beauty of his stroke, the matches that he won for us, that is what is appreciating him, rather than sitting in a quiz book and by hearting how many runs he has scored. That does not make it, the whole purpose of having a player or an actor like him is lost when that is what the focus is. Similarly, in investing, the end is what matters in terms of the goals that you have and how you reach them, rather than being able to say that tomorrow market will correct by 1% or 2%, day after tomorrow Tata Steel price will go up, or HDFC Bank में कुछ correction prices में आएगा, instead of predicting all of that. So don't go into that overconfident zone, but when in doubt, you just stick to basics. That's basically the rule. And the gentleman whose picture I shared, Warren Buffett, he says, whenever I've been overconfident, I have made mistakes. So even people like him say that time I was arrogant. I'm not using the word arrogant, I'm just saying overconfident. But overconfident gives you, a lot of possibilities that you will go wrong big time. Now, what is a world, atlas or a map doing in front of you? This is basically to link a small example. It's a scientific fact. Okay, it's a scientific fact which is there, and how a scientific but in geography. So I'm combining chemistry and geography in this picture, right? Now, what is the geography? There are two parts of the country. If you see the blue dots, you can see the blue dots in in the area which is this part of the globe, right? China, and slightly lower on this side. And the red dots are on the opposite side. So if you visualize this to be a globe, when you look at the globe, China faces you. If I'm facing India and China in the globe, and the US comes behind, so it's completely opposite. That is why it is day and night, right? When we have day right now, we are in the evening, it's morning time for people in the United States. So it's completely on the reverse part of from where we stand. So geographically, that is how nature has constructed it. Now, what are we going to talk about it? So, copper is not found in geographical proximity of one another. Okay, and there is this famous scale which is called MOHS scale, that there has been a combination that got made where two things that are found in nature got mixed up. Like for instance, we all know that diamond is the hardest substance and the softest substance is baby powder, and we use both of them, right? As baby powder is considered to be one of the softest uh, products that is available in terms of, and you need it because it's meant for the tender skin of the baby. So wherever you find two things that you combine, in nature you find them in extremely opposite places of the market. But when you combine them, what chemistry teaches you, the alloys, you combine two substances and you come out with a third product which is much more stronger than the two things that came out. So copper and bronze, if you were to take, right? So copper is one and bronze you make out of it, but the combination is what is the strongest that you get. So this MOH is a chemical scale, like a weighing machine scale. It's not a weighing machine, but it quantifies the strength of metals. So when you take two metals which are relatively lighter or low in strength, and you combine them and you come up with a product which is much more stronger. That is a rule in investing that is extremely important. Can I take equity, combine it with something weaker? So equity, I believe that it will be high in return. Yes, but it also comes with high in risk. Can I make it with something which is weaker in return, but stronger in risk and get a solid portfolio? A simpler example, if chemistry and geography is difficult, milk and lime juice, right? We have a liter of milk and I need 2 drops of lime juice to completely spoil it. But now spoiling is one way. The other way to look at it, I get paneer out of it, which is a very high, rich in protein, good stuff, and we all love to eat. And you make multiple things out of it. We make, paneer gravy or paneer masala. We make sweets out of it. Milk is healthy. Lime has got its own properties and it's good. Lime juice. We have lime soda. We use it in various other formats, right? In everything that you eat, you just put a tinge of lime, whether it is vegetarian or non-vegetarian. Pav bhaji, you use it. So you use lime, but 1 or 2 drops is different to change the character of milk. So when I combine products, when I combine two metals, when I combine milk and lime, when I combine equity with gold, when I combine equity with real estate, when I combine it with fixed income, the portfolio, the product becomes much more stronger. So important to know what are those products, what are those metals that I can combine to make it really strong in my portfolio. And nature teaches you that. What are we showing you here? I'm showing you 3 different products or 4 different products that you can always have. A short-term fund, which is like a fixed deposit for an investor. You all love gold. We all invest in gold as Indians. We buy gold jewelry at home. And recently, even in investing, it is being spoken about because of the way the prices have corrected. Nifty represents equity, which all of you I'm sure do, and international investing, something that we have probably missed for a long time in adding to our portfolios. Recently, a lot of information, a lot of talks, and people like Gaurav will be recommending that as well because international investing is becoming important, right? Now, when you combine all of this, one has given you 8% return, another gave you 14%, international and Indian markets gave you 10 to 14% return. But the beauty is, if I had invested in gold for the past 10 years, the first 10 years, I did 15 years, first 10 years, that is 2005, if I had invested till today, which is 15 years, till 2015 or 2016, I didn't make any return. Last 2 to 3 years, the prices have gone up. So I would have thought that gold as an investment is very poor, right? Similarly, if I had invested in the US equity markets from 2005 to 2020, again 15 years, which is what the chart also shows, it's only the last 5 years the markets have done very well. First 8-9 years it didn't do well and India did very well. So we may have felt why did I go to US and invest? I should have invested in India. And last 5 years, Indian markets have done much worse than the US markets have done. So all of this is about timing. Did I enter at the right time? You don't know that, right? I cannot say what will happen to gold prices 10 years from today. But all I can say that is not my ability to predict. But one thing I can say with certainty is it has to be part of portfolio. International investing has to be part of portfolio because There are businesses which you can only participate through the international market, and they will do well at some times when Indian markets do not do well. Can I be never ever investing in fixed income products? No, I do need that balance in my portfolio. Much as I may like sweets, I don't eat morning, evening, night only sweets and fill my stomach. I may eat more than someone who doesn't like sweets. But at the same time, I will eat roti, rice, dal, sabji, egg, whatever I have to eat, I will, other than sweets. I can't say I love rasgulla and all my 3 meals are rasgullas. Then I won't live to eat for too long, right? So therefore, each of them come with their own combination of pluses and minuses. Please have all of them in your portfolio. If you had put 25% each, that is why it is called a don't predict fund. In the last 15 years, I made about 12% return. Or these are, none of them are DSP schemes. I'm talking about index investing. Okay, I'm not recommending that, but I'm just using that as an example. So it is better than the fixed income. It is better than the international return. It is very close to gold and equity of Indian markets. So, but the advantage is you didn't have to jump like a monkey that aaj gold, kal international, parso Indian equity, then everything is bad, so I go back to an FD. You don't have to do that. All of that. That is why investing is said to be a thali meal. You need namak, you need sweet, you need papad, you need pickle, you need 2, 3 sabji, you need rice, roti, everything. It's a wholesome meal. That is why you give all vegetables to children. We say balanced diet. Why is it called balanced? Because every aspect that your body needs, it is given through that diet. Green, oil, everything is there. So the same way your portfolio should be balanced, and in balancing, you don't predict. Because why do you do more of prediction is because you think that is going to do the best. Yes, it may do the best, but will you know when it will do best and when it will not do best? Okay, I have come to the end of my presentation. I'm going to just end with two stories, both quite interesting, and probably, if nothing, that will leave a memory with you about investing rules. One story goes as it is like this. You're seeing the picture of Lord Shiva and his, Tandav, and then there is a farmer who is tilling a field. Okay, now what is the story about? The story goes like this. There was a village in which there was no rains happening, right? There was drought. And as usual, we want to please some rain god to get rains. And, the villagers, the older people in the village, elders, they all decided that the rain gods are angry with us. And that is why we are not getting rains. Let us pray to God and, let us get the rain. So they do call a pandit, set up everything for a big puja. And, he says, let's please the rain god. So they does all mantra and everything. And the gods are. So Narad goes to Lord Shiva and says, in this village, there is a problem of rain and they are praising the Lord, of rain. And you have to tell the Lord rain to shower rain in that particular village. So Lord Shiva is very angry. He says, no, I don't like those villagers. They have been bad people. So I'm going to punish them. I'm not going to tell the Lord of Rain to give them rain till I play the damru. And for the next 12 years, I'm not going to play my damru. So when I play my damru, a Lord of Rain can give rain in that village. That is my instruction to it. So Narad comes back and tells the villagers that, see, this is the reality. You can do the puja and everything, but nothing is going to happen because Lord Shiva is very angry, and without his playing Damru, rain god will not give you rain. So I don't know how to help you. I was your messenger. I represented your case to him, but he is not listening. He is in a very angry mood. So this conversation between Narad and Lord Shiva, Parvati Devi has been listening to. Now, while this is all happening, there is one farmer in the village who is tilling his soil, who is doing everything. He's taking his bullocks and going to the farm, field, everything he is doing. And when somebody asked him, why are you doing all this? No rain is happening. He said, ye mera dharam hai. This is my duty. This is my काम. I will continue to do that. Let the rain happen whenever it happens. Okay, so he is only one who is not listening to all this puja and, Narad ke saath conversation and all of that. So then Parvati Devi, after Narad goes back, asks Shiva that, Lord, you said that, for 12 years you are not going to play the Damru, and these people will not get any rain. But what will happen in 12 years? Will you remember how to play the Damru? What if you forget to play the Damru? When you take it in the 12th year to play the Damru, you may have forgotten how to play. You are not practicing. So then Lord Shiva gets very, unhappy about it, and he also feels scared. He said, yes, that is a possibility. In 12 years, I might forget what I have to do, right? So then he says, okay, let me just try whether I have lost practice. And he plays the Damru. Now, Lord of Rain, he doesn't know this conversation. He doesn't know Shiva is only practicing. He gives them rain. The rain starts happening in the village. So all the people in the village who didn't do anything because Narad Muni told them that there will be no rain, didn't benefit, and that one single farmer, without listening to any of this noise, by not looking at any other map, he just kept his Google map, which is to do his work, and went to his farm and continued to his work, immensely benefited. Moral of the story, continue to invest. Don't listen to predictions, whether it is Narad Muni, Lord Shiva, Usha, Gaurav. Don't listen to any of us. You listen to us when you need the correct guidance. If we behave sensibly and give you the lighthouse guidance, listen to us. But don't listen to noise about what will happen in the market, and stop your journey of investing, because your duty is the journey of investing. You have to invest. Staying away from investing is not a solution. If markets are expensive, we have products which will give you that comfort. If markets are cheap, we have products that will give you that comfort. So please invest and be like that farmer, because you really don't know when will Shiva decide to practice Damru and when will rain happen. If you feel there is drought now, then also you continue to till the soil. If there is too much of rain, then carry umbrella and build ark around you. The last, more than a story, it's a small example. We all are fond of elephants. India has a lot of elephants, and we do see many elephants. And we are also fond of baby, kittens. Cat gives birth, and there are kittens that we see, and we find them very cute, right? Now, an elephant carries its baby for 18 months, and then it gives birth, and a cat carries its baby for about 3 months, 60 to 70 days, right? When a kitten comes out, the weight is about 100 grams or 200 grams, and when an elephant comes out, even a baby elephant, it is 100 kgs. Okay, so when your gestation period is high, the output that you get is also fairly large. You're investing, the longer it is, the larger it becomes. It does not matter whether Biden came, COVID came, or what did Nirmala Sitaraman say 2 weeks back. Does not matter. In 15 years, all of that is forgotten, because when you need the money, it is not going to be Biden, it is not going to be Nirmala Sitaraman. It's going to be something completely different. But in 15 years, you need the money, you need an elephant portfolio, is for sure. And you don't need small cat portfolios. So if you want an elephant portfolio, stay long, stay invested. Otherwise, you may end up having a cat portfolio. Gaurav, thank you very much. And over to you for any further discussion.
Thanks, Usha. I think you covered most of the important parts that any investor should look for, and most of these rules are once understood well, they can be implemented, and I think it can really help every one of us to manage our investments in a much better scenario. And especially now, the cycles are now reducing. That the time frame of the cycles are also shorter. So in 2 years, markets show you very good returns, and then another 1 or 2 years it shows you bad returns. So the cycles have also shortened, and so these rules really help. Now, one or two important aspects I wanted to take your views on. So one is SIP investments.
Yes.
And we keep getting a lot of queries from investors, and that's the most basic investment tool, also available through a mutual fund route. So it's a form of a disciplined investment But people, when they look at the market, so if you look at today, the market, it has rallied significantly from the lows. A lot of people want to know whether they should continue their SIPs now or they should stop and wait for market to correct. So can you throw some light on this?
Sure.
What's your view?
So, Gaurav, I'll answer that in two parts. So people did stop their SIPs in March, and I'm talking about the recent episode. And we have not. I mean, I'm sure you and many of us who have been in the market have seen such experiences in the past. 2020, March was not the first time we experienced it. But for the benefit of the audience, some of you at least may have probably stopped their SIP or thought of stopping the SIP when this event happened, because then 3-year returns, 4-year returns were not looking very attractive. And if you had waited for 6 months, that is actually, it is in April we added that Shiva story into all our conversations, because we were finding that a lot of investors who have invested for 3 years and 4 years and, SIP sahi hai, SIP sahi hai, that is what we had, as an industry, we had tried to tell our retail investors. And many of them had imbibed that, but somewhere in between you're throwing the towel. So we wanted to sort of, in a very nice narrative, tell investors, don't do that. Please continue to do your investing. And if you see today, the same investor who probably didn't stop would be having a much better experience just in a matter of 6 to 7 months. In March, did we say that this is going to be the reality? We did. None of us knew that, right? But the point is, that is what that rain god's blessing is all about. It happens when the least expected. You never expected vaccine will happen like this, market will recover, the flow of liquidity will happen, etc. So my simple point is, never ever stop your SIP. You have to continue with your SIP. Even if you have done well, even if you have continued, you want to take some profit. I've done, say, 1,000 rupees SIP or 2,000 rupees SIP for the past 5 years. So every year I've invested about 24,000 rupees. My total investment is 3 to 4 lakhs, and it is today looking at 6-7 lakhs. Fine. If that is the case, please take 20% off, 30% off. But you take the money, buy a gadget if you want to buy, you want to travel, you do, you want to refurbish your house, you do that. Money you're investing is to enjoy. That is fine. But can I not continue my 2,000 rupee investment? Why should I stop that? Because that is coming from my monthly income, my salary, my business income, my business, my pension income. Why should I stop that? That will continue as long as I'm working, right? I don't need that money. If you need it, take it. Just because market is doing well or bad, don't stop your investment. I don't stop eating because prices have gone up. I don't start buying petrol when I don't stop traveling when petrol prices have gone up, right? I still fill my petrol tank in the car or the two-wheeler. I still buy the tomato at 100 rupees a kg and consume, right? So why, when it comes to markets, you stop? That is a discipline, as you very rightly said. That discipline should continue, no stopping. Take some profits off the table if you have made profits. Gaurav and his team will assist in that guidance, but never ever stop SIPs. That's the biggest mistake that one can do.
And also this relates to the one of the rules that you said, don't predict. So
yes, absolutely. Yes, because if you would have predicted in March something bad and the opposite happened. So your action was basis that prediction, and whoever predicted has gone wrong. Gaurav, honestly, I have WhatsApp messages with me even now, which predicted 4,500 of Nifty in March. And look at where Nifty is, right? So people went to that extreme, and that's the way it will always happen. So don't predict and don't stop SIPs.
Also, one of the rules that you were mentioning also was don't be lost in excess info.
Yes.
So I am just trying to connect this with the there are some funds which are rule-based funds like quant funds or balance advantage funds, and today because of the excess info that people get, they are also not able to decide the right mix between equity and debt. So do you feel these are the products which really do that for the clients?
Absolutely.
And they can rely on them?
Absolutely. So to link, wonderful question, Gaurav, and to link what you asked first and to this. So I can take and I'm sure that is a reality for many other funds, but because I know DSP data very well, I can quote that. DSP Dynamic Asset Allocation Fund was 30 to 40% in equity sometime in January to March of 2020. We didn't predict COVID. The market valuations were close to 40,000. BSE Sensex was close to 40,000 in January. And because markets were expensive, as the rule first said, when markets are expensive, be cautious. We reduced the equity exposure from 40 to 30%. Now March happened and it's an opportunity. We always say that when prices fall, it's an opportunity in equity investing. It's not a time to panic, it's a time to buy. Like the sale that happens. So from 30% in equity, so the 100 rupee of the client was 30% in equity and 70% in fixed income. 30 moved up all the way to 80% by May. Now, what is interesting? This is not worth it if I say, oh, we did it. That's not the important part. If you had 5 lakh of rupees in a product like that, when the market corrected 30%, it was only 1.5 lakh that was there invested. The remaining 3.5 lakhs was sitting in a bank deposit equivalent, where without you realizing as Gaurav Talwar client, the mutual fund moved that 3.5 lakhs to equity at a price of 7,500 levels of Nifty, which would have been extremely difficult for you to do as an individual because your worry is so much. So you didn't do, what did you do? You gave me a check of 5 lakh rupees in January 2020 without telling me anything. I bought 1.5 lakh rupees worth of equity and sat on it, kept 3.5 lakh rupees in fixed income, 30% of 5 lakhs, 1.5 lakhs. And then when market went to 7,500 and March, April it happened, without asking Gaurav what to do, from that 3.5 lakh rupees, I just moved it to almost 4 lakhs. I took it. That is another, nearly 3 lakhs from the 3.5 lakh I took, and I invested it into equities at prices which were so cheap. And then you continue to go up with that 80% equity investment till about October, November. And in October, November, I have now again made your portfolio sit at 30% in equity. So the beauty is Gaurav does not need to do, any client need to do. And I am worried as an individual at that time, why should I put money? But because this is model or rule, it's like a machine, it doesn't care. It is doing it blindfolded. And doing it blindfolded is helping him very, very well. So my portfolio fell less. It participated in the upside. And now again, I have automatically booked profit. Advantage to the client is no tax implication, no exit load problem. So rule-based will work because we are emotional. The rules are unemotional.
Yeah. So we have 3-4 questions which I can see right now. We will just take those questions. So one of the questions, relates to what we talked right now, and that says markets have rallied 40-50% recently. Should I continue my SIPs?
Yes, you should continue your SIPs, but don't expect markets will continue to go up another 40-50%. Your SIPs, I hope, are done for the long term, 5 years, 10 years, etc. And if you have, so let me answer it in this way. Suppose you have done a SIP in 2009 and you have done a 10-year SIP or 11-year SIP, and you're coming closer to your SIP maturity, please, you have all the right to take a decision not to continue or to stop or whatever. But if I started a SIP in 2015 or 2018, and my intent is to do it for the next 10 to 15 years, that's why I started off. I'm only 10 or 20% into my journey. So why should I stop my SIP? I will continue with my SIP. That would be my answer. So if you have a need, like people do SIP for children's education, buying of house, daughter's marriage, lot of things. If my need is visible and I'm closer to the need, you have nothing wrong in taking money into your pocket, because it's good to sell at a high price. But it is not. You have a 2-year-old kid or a 5-year-old kid and you've started investing for him or her, and you need money when she's 20 or 15 years to go. Please don't stop your SIP then. But expect that it will be patchy. And it is good when you do SIP to have volatility, because I buy more units at that point of time.
Same applies to other asset classes. So we have got few questions on gold. Again, people invested when the gold prices touched all-time high, and then it has come. So answer to that question also is the same, that you should continue investing and maintain the allocation.
Yes, absolutely. Correct. That's absolutely correct, Gaurav, because gold prices didn't move at all, and then it suddenly moved up significantly in the last few times. And if you have invested when the prices were say 50,000, etc., it is corrected from those high levels, but continue to maintain your allocation.
Right. And then, there is also one question on the NAV of the fund. So a lot of people get confused that buying a NFO or a fund with a low NAV is correct. How do we address that point?
Okay, so that is the biggest myth in our investing world. We somehow seem to forget the small arithmetic class that we have all attended when we went to school. It's class 7 maths, right? Return investing is about percentage return, whether I make 5%, 10%, or 20%, right? So it is easy. Any of us who are employees, which me, Gaurav, all of us are, we know if my boss tells me I paid you 10,000 rupees increment or 2 lakh increment last year and I'll pay you 2.25 this year, I'm giving you more. We are not going to be happy about it, right? We always look at what are percentages. When your kid comes from school and says that I got 10 marks in one exam and I got 12 in the next exam, you're not going to do sabashi. You'll say, what is the percentage? Out of 100, did you score 10? Or out of 20, did you score 10? So again, it becomes a matter of percentage. So it's not, we are not wired mathematicians, so we don't do it that way. So we feel comfortable at a lower price point, but that is wrong. What matters is whether you buy it 100 rupees. So today, if you have a fund which is at 100 rupees and you are buying it at 10 rupees, if 10 will become 11, which is 10%, 100 will definitely become 110. Please take it from me. It will happen that way. So no advantage from a 10 rupee NFO. Sometimes, Gaurav, why this question comes from investors, people confuse it with IPO behavior. Buying a stock in an IPO versus a mutual fund NFO, they're very, very different. Right. And even in IPO, today with experience that even if I bought, because this thought is inbuilt in people's mind. Since I bought an Infosys IPO, I bought a Reliance Industries IPO, I bought Tata Consultancy Services IPO, and the stock has gone up 20 times, 40 times, 100 times, right? But then after the IPO, the stock corrected also at some points in time. Right. So there are people who bought when the price corrected. So even after that, don't confuse an IPO issue with an NFO of a mutual fund. Mutual fund comes with an NFO because I have no product. I have to launch a product. I will come with an NFO. If you buy a DSP's fund, which is existing at 100 rupee NAV, and a new fund, which is similar from another fund house at 10 rupee NAV, if they give you 20% return, be rest assured, we will also give 20%, all being equal. My 100 will become 120, their 110 will become 12. Both of us will give you same return. So there is absolutely no advantage in buying a 10 rupee NAV. That's a wrong thing that, it should be completely erased from your mind.
Thanks, Usha. So, Usha, we are coming to an end for this session, and I would like to thank you a lot for sharing your views on such an interesting topic. And I'm sure all our viewers would have gained a lot of understanding. And if they apply these, rules,
yes.
So these are the basic rules. And if they apply, I'm sure their investing journey will be quite good. So I would like to thank all our viewers. And also, please download our Moneyfy app and start your investment journey. It's a fully digital app with a fully digital onboarding journey and host of other features to help you select the right funds. And do also subscribe to our YouTube channel for more updates and updates about more such sessions, and also a lot of details about different investment avenues. So thanks, Usha, once again.
Thank you, Gaurav, and thanks to all the viewers. I hope you have a great investing journey. Thank you very much.
Thank you.